Hi there. So, continuing with the theme of trading psychology, this video is going to cover loss aversion, which is a real problem amongst traders both new and experienced. So, first off, what is loss aversion? So, we've all been brought up with this concept that losing something should be avoided, but when it comes to trading, it's quite a dangerous mindset to take because it stimulates fear when the market moves against us. And what happens is a lot of people end up holding losing positions with hope because they're too afraid to close a trade. This view of winning and losing doesn't account for any kind of risk or reward factor. And we'll get onto that in a second with some charts and some graphs. But first, let's just go through a quick example. So we've got these two hypothetical traders. One's experienced and disciplined, and one is a rookie. So they both decide to buy oil at the same price. I'll just get this graph up here. So imagine they both decide to buy oil. This price here. So this is back in 2014 when oil was about $106 still, not down at 40. So imagine they both buy oil here, and they both got their stop losses. So what happens is they buy here, the market starts moving away from them, and the disciplined trader stopped out. He closes his position, takes the loss, and moves on. Whereas the rookie trader sees the market go the same way, but he's too stubborn or scared to take the loss. So he decides to give the market a bit more time. So what he does is he moves the stop loss further away, just to see, with the hopes that the market turns back. And as you can see, he's wrong. The market keeps on going against it, but now it's even harder for him to accept this loss because it's twice as big. So if he couldn't accept the loss the first time, he's not going to accept the loss the second time. Now it's twice as big, so he increases his risk even more. So then he moves his stop loss lower, and as you can see, this pattern repeats itself. So he moves his stop loss further, the market keeps going, and his risk gets higher and higher, and it gets harder and harder for him to close his position. And he's losing more and more along this way. He's getting more and more scared. It's more and more difficult for him to manage his position. And eventually he's either forced to take the loss because he's run out of money, or his loss is so big that his account is not going to recover anyway. So I've seen this happen so often, and it never ends well. It only takes one big move against you, and using this system or this poor disciplined process, you can lose everything. So just to emphasize this point on win rate, I've got this histogram here. So this is a trend following strategy we tested for over 2,000 trades. Came out with an annual growth rate of about 80%. And what we've got on the left hand side here is number of trades, and the bottom is the risk to reward category. So a minus 100 would be if you're getting stopped out. 100 here is 1-to-1 risk reward, and then 2-to-1, 3-to-1, etc., etc. So you can see on the left hand side, there's actually way more losers in this system than there is of any other risk to reward area, and the win rate was actually only 45% for this. And just to show you that this isn't the poor system design, this here is the exact same chart. So number of trades on the left, risk to reward on the bottom. That was used by Richard Dennis, and if you don't know who that is, he's one of the most legendary traders that have been. He turned a few $1,000s into 200 million, and then did a very successful experiment teaching people how to trade in the mid-80s. If you haven't already read it, definitely read The Way of the Turtle. It's absolutely excellent book on how to trade, and you'll learn a lot of things that you maybe didn't know or very counterintuitive from that book. But this is taken straight from there. I haven't changed the numbers at all. I've just kind of put them into a nicer format. So you can see this win rate on here is actually only 35%. But if I scroll down here, what we've done is weighted these. So on a risk-adjusted basis, this 35% or 45% win system is actually very profitable. So what I've done here is you multiply the loss by the risk, or the number of losses by the risk to reward factor. So we had 103 losses up here, or 1,030 losses up here, and that corresponds to minus 103,000. Just times it all by 100. And then similarly with the other ones, so you can actually see that these higher risk to reward trades start to offset these constant losers. So what happens is a system with a win percent below 50% actually becomes very profitable. Now imagine this system if rather than having this bar chart here or this histogram here capped at minus 100, if you were a trader who extends your stop losses and lets losses run more and more, and you had minus 200, minus 300, minus 400 trades on here, this profitability would be completely destroyed. This net profit would be negative. You'd have trades all the way to the left hand here that were like way outweighing these profitable ones here. So just goes to show that there's nothing wrong with taking a loss. Don't be scared to take a loss. taking a loss is part of trading. It's about how you handle them that's crucial to your long-term success. So if you ever find yourself extending your stop loss, just remember that it's not going to end well. It's only going to take one time. One time that the market moves away from you, it's so much better to take a small loss early on than a big loss later when the markets move against you and you've had all that stress of dealing with a losing position for so long. So thanks for listening to this video. There's 2 more videos coming on trading psychology, both handling different concepts. So make sure you check them out. Thanks a lot.